Hello, 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 and welcome to the Monday edition of Behind the Markets to everyone. Sorry for the little delay, but we had a little bit of a technical error. But thank you very much for being with us today, and to those who have managed to join us. We know that we're a bit off this morning, but this morning it is Mindset Monday, where we'll be catching through quite a few things. Today we'll be going through our bond auction, which has to do with the data that came in on Friday from the Friday bond auction. We'll be taking you through some family information on our Monday, our Mindset Monday. I want to talk to you a bit about trends and family information. And finally, I wanted to talk about diversification. The big question: multiple streams of income versus single streams of income. We've had this massive debate in society about whether people should have a focus or whether people should just do as many things as possible. And it seems to always be there's the exciting answer and there's the realistic answer. These are the two major things that we have to try and have a conversation about. So, without further ado, thank you very much to everyone. And we're going to get in touch with our show. Vernon will be joining us a little bit later. But we are going to start with the data coming out of the February bond auction. The first piece of information that we did see yields barely move up except for the 2-year yield. And if we go through our quick share right here, you will see that the 2-year yield is the only thing that moved up from 17.4%, 17.5%, all the way up to 18%. And that has gone up. And as you've seen, the other yields have not changed at all. You can see that they're all pretty much the same, except from a year ago, you are seeing that the 3 years up 2%, 5 years up 1.75%, 7 years up 0.95%, 10 years up 2.26%, and the 15 years up 1.76%. You can see all in all yields are up generally from a year ago. You are also seeing that the general composite yield is down, and that's mainly because of shortening of bonds. Remember, the shorter the bonds we are, the more the composite yield starts to come down. Now, going into some of the specifics of the auction, of the performance of the auction, the specifics of the performance of this last auction. We did see that, unfortunately, this happens to be one of the worst performing auctions in the last since December 2020. As you can see very quickly here, at the bottom, you can see that the full out performance, total sales performance of the auction was as low as 25%. You can see here, quite at the bottom, it's 25%, while the top end was 37.11%. This was a horribly attended auction with only about 600 million kwacha in sales out of the 2.6 billion kwacha that was being looked for. As you can see, every other auction we've seen at least some decent performance. This 25% marks the lowest that we've seen since December 2020. Where we only had 20% of performance there, but everything else has been much higher than this. The only thing that came close was July 2022, where we got to 27%. So we do seem to be losing some steam when it comes to auction data. So auction performance has been poor on the last one. We didn't see a strong rally in terms of a large amount of purchases when it came to this last auction. Now, looking at the performance of each tenor, how did each bond tenor do in the auction? Here it is. We did see that 86% sales for the 2-year bond, 48% sales even for the 3-year bond, and only 8% sales for the 5-year, 2% sales for the 7-year, 18% for the 10-year, 13% for the 15-year, giving us a total of 25%, versus last month where we saw 102%, and we saw mega performances in the 2-year, the 3-year, the 5-year had a decent performance in the 10-year, mainly driven by rollovers. In other words, you saw quite a few bonds that were actually able to now serve off. Now, one of the things that we need to pay attention to here is that we seem to be going through some cyclical nature when it comes to bond auctions. Our bond auction sales performance as a percentage of the target. Remember, this is a percentage of the target sales. We are seeing that there are some cycles that are starting to pick up, that every time there seems to be a strong maturity every 3 months, that's when we'll see a very good bond auction, and we won't see a good one in the market for a little bit of time after that. And that was pretty much how most of the market performed. Now, let me get you quickly through just the sales for each of the tenors or each of the bonds themselves. This is the data that we're actually seeing as well. We saw 257 million kwacha worth of sales coming through the 2-year, 191 million kwacha worth of sales coming through the 3-year, and only 49 million kwacha coming through the 5-year, 6 million for the 7-year, 92 million for the 10-year, and 50 million for the 50 million for the 15-year. And you can see this versus last month, where we had 600 million for the 2-year, 588 million for the 3-year, 926 million for the 10-year. And this is what I mean when it's a shocking change around. We are seeing much lower, much weaker performance in our bond market just for this specific one. Now, two things obviously that can be brought out here. Two of the main things that can be brought out here is that we did get our MPC statement, which did obviously highlight a few things about lack of offshore participation, how that's been managing to slow down, while at the same time we did also have the squeeze coming into the market in terms of the statutory reserve ratio, which also now obviously tied up a little bit of liquidity. But you are getting a lot of payments of maturity still coming out. You had 1 billion kwacha worth of 2-year maturities, which still didn't go back into the market. So I think that's one thing that most are being concerned about as to why major parts of the market are not showing back. Now, this is our summary table that shows us how sales performance has been. You can see that all of them across the board were down 76% in general from last month's sales in terms of bond issuance, or in terms of how much was raised, capital raised. You can see 61% down for the 2-year, 91% down, 67% down for the 3-year, 86% down for the 5-year. Across the board, almost everything had gone down, 90% downwards, even for the 10-year. And you can see even when it comes to change, monthly sales performance change in terms of the target. You can see performance versus the target. You can see everything is down drastically across the board. Still, we have the composition of 77% of sales coming from the top end. In other words, the short end bonds. That's what has clawed back the composite yield. While simultaneously, we've seen that even the composition of bonds was mainly 2-year, 3-year, and the rest pretty much came down in terms of their composition. So that is where we were. That is where auction data has us in terms of the 2020. In terms of the 2020, the February 2023 bond auction. That was a huge piece of data coming out there, and that was most of our auction trends. And therefore, it's signaling that we're still in that era of uncertainty, still waiting for a deal to crack. We got 1 month left before the end of the quarter, when basically deals galore have been trying to be gotten through. But you can see there's a lot of pressure and there's a lot of tension building up in the market. You can see that even our president and even our minister of finance have had to are buckling under a bit of the pressure right now, inciting that, look, these things are taking very long. We're looking at almost 2 years since they came into office. And what we're seeing is even the FX rate is speaking negatively against them. You're seeing your FX rate holding a position of lower than, you're seeing a FX rate holding a position of 19.472. So this is much higher than where it was when the president walked into power, or walked into office. The kwacha was about 19.32, dropped to about 19.2. So we're deep into pre-election levels, and we seem to be getting that same momentum, heading us back to 20. Okay, until we see a reversal, it looks as though we're on the path to 20, similar to that horrible bond sale that happened. Not horrible bond sale, horrible FX sale that kept on happening back in 2020 going into 2021, where we had 200 days of consecutive kwacha selling. It looks as though we're heading for that kind of day, that kind of year, where there's just everything against us in this situation. So prep yourselves for the kwacha going downwards, at least continuously. We'll see if the central bank can continue selling. But remember last year, we even said last week, we even said the central bank sold a record $400 million in the third quarter, but poor mining output and poor mining sales, and therefore heightened import costs of pharmaceuticals, fertilizer, and fuel still led to a lot of leakages in the system, and therefore we do not have a strong forex rate. Okay, so these are the three. Those are the key issues that are affecting even our forex rate. So in general, we still are sitting in a negative sentiment, and we're not getting dollars coming in through our bond market. And that just lies in our early tracking of how markets have opened up for this week, starting with our bond auction data. We'll be looking at a lot more information coming into the market, especially when it comes to the commodity sector and how that affects us. Remember that we still have an oil read that we're waiting for, and everything is still speaking to a 3% rise in fuel prices. We're still expecting about a 3% rise in fuel prices coming up this at the end of this month. If anything, that is the main driver. But we're seeing that oil is up to 83.63 dollars a barrel, so it's still trading above 80. Copper it dropped back down below 9,000, but it's just slightly, only about $10 below 9,000, while gold is at about 1,852. So a lot of these assets are still sitting at the price levels that they were with gold. With gold and copper down and oil still up. So we still have quite an expensive import that will still slightly play against us. Remember, that is the thing we're trying to avoid here. But unfortunately, oil will still continue to play against us with the weakening of the currency and an $83 oil price. We will still keep, unfortunately, still playing a negative part of the oil market, and it's going to be rather difficult for us as a country. So pack in yourself for a little bit of inflation pressure, especially from February, March. There is a little bit of inflation pressure that is still set to pounce on us. Now, taking a look at the market indicators that we should be looking at from last week, from the beginning of the week, also touching into the weekend. We are starting to see data coming in from China, America, and also from the rest of Europe, though it's a holiday in Canada. But we did see that PBOC loan rate stayed exactly the same coming out of China. Data that's coming out this morning is German PPIs. We're waiting to see that supply chain information from Germany to see that producer price index prices are probably come down on the month by 1.2%. That's the expectation, with 2.08%, 20.08% year-on-year inflation in the supply chain coming out of Germany. We are expecting that we're going to see U.S. import and export index also coming into play, while we're also going to be looking at fiscal balances coming out of countries like Mexico, and also speeches coming out of deputy governors coming from the Bank of England. Main news also will be Japanese PMIs, manufacturing and services, with the expectation that Japan is still in a manufacturing recession, which is affecting global supply of things. So that's the data that we're expecting coming out today. Remember, the Monday is always a slow day with construction output, looking at how that's doing for copper coming out of Europe. That is the biggest piece of data that we're looking at. So these are the biggest pieces of data we're looking at on the global economy. Right. To everyone, thank you very much once again. That's been our roundup of the morning. Now it's time to get into some deep dive issues and the thoughts that come with it. Now, over the weekend, we were starting to look at family statistics, because one of the main reasons we do this is because family decisions and family statistics are the family is the biggest conduit of wealth creation. Most wealth is transferred through families. Most ideas are generated by family people. So we are going to start looking at family data, and also to start looking at how that affects people's financial decisions. Family formation is the single biggest decision that people go through, whether getting married or whether building a family, whether having children. Family is always going to be the biggest decision that an individual is likely to make. So let's take a look at what some of the trends are. Now, the biggest trend that we actually picked up on over the weekend has got to do with family dissolution statistics, which is divorce. The dissolution of marriages is actually the biggest piece of data that we're going to talk about, and we're going to try and go into some of the dynamics and some of the trends that are actually affecting this very piece here. Now, I say this because one of the biggest reasons we have to talk about something like this, and as you can see, this is actually quite shocking information to see the rise and escalation we're having of divorce cases in this country. 2019, we're looking at from 2019, we're looking at 20,818 divorce cases. By 2022, we've registered 50% more than that. These are the number of couples who are taking each other to court and they're dissolving their marriages. Now, you can see there was a spike in 2020. Obviously, pandemic was a horrible year for this. It slowed down in 2021, and then we're back up at it in 2022. As the economy always gets tough, it appears that couples get at each other's throats. And I think last time we talked about this, where we talked about the change in the economy leading to the change in the need for the family structure. As we were in the food economy, we needed extended families, multiple, this huge families. But then when we went into the agriculture, the industrial era, we needed the nuclear family. And it appears when the computer and knowledge era, it appears that the single parent family becomes all the vogue. But unfortunately, that comes with itself a lot of implications that do slow down human development and do slow down wealth creation and wealth development for as many people, and starts to also create a lot more inequalities in the economic system. Now, as we said, the key indicator we're going to start here with is the issue of the number of divorce cases that we are seeing. And if you go back into the trends of history, you are also seeing huge numbers of divorce grants, which keep rising and rising and rising to the point where we're getting close to about 20,000 divorces granted per year. I think last year was a bit less. I think about from the 31,000 cases that were heard, about 15,000 divorces were granted. But these are families that are terminated effectively. Now, there is I talk about this, and we're having this conversation about it because, as I said, marriage is the single biggest financial decision an individual will make, and divorce is one of the single biggest devastating events that leads to people losing a decade of their life. When a couple separates, the financial state of the two individuals usually goes back a decade. They lose a lot of the assets because of dissolution, because of emotional stress, because of so much. They even sometimes even lose their earnings capacity, lose their businesses. There's about a decade's worth of financial loss that people face when it comes down to divorce or dissolution of marriage. So they're just some things that, if we're gonna start seeing such high divorce rates, let's start breaking down some of the trends that are following it, and let's also try and look at what the implications of all of this are and what it means for even family selection. So, for as many people going into relationships, you have to understand that there are economic implications. And the question I want to answer today, unfortunately, we're still waiting for my co-host, but the question I wanted to answer today is: does income matter in selection? Because some of these issues do stem from selection issues. Okay, and maybe not selection issues, but even progress. And I know when we start talking about money and marriage, they seems to be this cringe that we are somehow dissolving or destroying the institution itself, when there's some realities that we need to start facing. Now, when we go through a lot of the divorce data, one of the things we keep seeing cited here is cruelty and infidelity. Okay, communication breakdowns and infidelity. Those are the biggest issues that seem to be coming down on the side of families not being able to stay together. So I'm going to go through a few issues here that people should pay attention to. Now, some of this is US data, but what I do want us to take a look at is change in women. Okay. And I know this is something that can be sensitive. So everybody just needs to maybe pump their brakes a bit and just understand the information before we go through it. But there has been a change in women, the most drastic change in the last decade, which unfortunately has followed a lot of the divorce information, has come up with change in women. So there are three things that we want to try and look at. And if you look at the first thing I wanted to cite is a cross-national study that was done by Sydney University, where the conclusions that they did, and when I say cross-national study, we're adding up a lot of the developed world nations, such as China, such as Japan, such as the EU. You are seeing the UK, you are seeing the USA. And here's what was found in a lot of these countries who are diverse in their culture. They found that the rising numbers of divorces are contributed to by four main factors. One, the rise in women's socioeconomic status. Two, the rise in individualism brought on by the technology age. Three, the rise in social acceptance of divorce. And four, the ease of anti-divorce laws, the easing of anti-divorce laws. Now, in another Chicago Booth University study, which was mainly US oriented, it was found And unfortunately, this is one of the biggest information that you find. It was found that when a woman becomes the household's breadwinner, because remember, we are dealing with social norms and finance. When a woman becomes the household breadwinner, and specifically speaking, when she makes more than 70% of the household's income, the probabilities of divorce increase by 50%. Okay, this is data that they did pick up, and it is across many. And let me even show you that a 2013 and 2014 UNZA study titled "The Predictors of Divorce Amongst Young Women of Reproductive Age: Evidence of 2013-2014 Zambia Demographic Health Survey." It found the following conclusion that it came to the following conclusion and found that when women attain higher education levels and financial independence, you do see the prevalence of divorce start to increase. Okay, amongst the women of higher education and higher financial independence, and the second one, financial independence is key importance. You do start to see that the predictors of divorce, or sorry, the prevalence of divorce starts to increase significantly. Now, there are some things that we should also look at, especially over the last decade when it comes to the Zambian woman. Now, the Zambian woman has gone through drastic changes, not for negative purposes. It's just that we need to learn how to navigate these changes a lot better as a society. So it's not to say because divorce is the outcome, we need to go and stick women back in caves. And no, that's not what we're saying. What I'm trying to say is you have to monitor the information to see what has changed in society that is leading to these, that is contributing to these outcomes, and how do we navigate the progress that we're trying to get by also not the destruction of family. How do we navigate these two things together and help them move together? Because families are very important for creating wealth. Families are very important for creating enterprise. Families are very important for education of children. Okay, solid, strong families often produce better education outcomes for children. They produce more entrepreneurs, and they produce more investment and wealth. This is the three strong things that we see from our society that families tend to do very well. Even Richie Sunak talked about it. He said family is the cornerstone of society, and he said family helps with small business creation. Family is what gave him strong education. Family is really important. I always say that the immigrants who do well in Zambia are willing to pay the fee. They have strong families, they have strong education, and they have strong enterprises. And family is the source point for education and enterprise. So it's very important for us to be able to look at family and say, how do we keep it together while still moving women forward? Because that is an important part of our discussion here. How do we keep it together while still moving women forward? And how do we have to now start navigating? Because this is actually more information for men more than it is for women about how you even navigate your marriage decisions and to actually do it with a bit more data approach. So let's take a look at the changes of the Zambian woman over the last decade. And what we've seen over the last decade is that Zambian girls are coming out of school more educated. If you saw the grade 9 and grade 12 results, in fact, the grade 12 results, what did we see? Top 50 students, 84% of them were girls. That already tells you the skew to better grades are coming out. That the better students coming out of school who are probably going to get the better university opportunities, who are probably going to get the better grades or even get better access to starting jobs. These are the girls of the next generation. Zambian women are equal participants in the labor market as they've moved from 60% labor force participation to 72% labor force participation versus men who have stayed at 80%. So we haven't increased our labor force participation. Male stagnation has been quite an important part of this. The wage gap has almost been all but closed as women went from earning 56% of what men were earning in the previous decade all the way up to now 97%. And in the formal sector, women are actually out earning men per hour. In other words, the average woman's working hour is 12 kwacha per hour in terms of real wages, while the average man's working hour is about 10 kwacha per hour in real wages. So in the formal sector, you've actually seen women are out earning per hour every man 20% higher. Now, let's look at the economic statistics, socioeconomic statistics of gender coming from the World Economic Gender Report that actually shows how women have changed from 2009 all the way up to 2019. The gender parity index has moved up from 62.9 to 72.6, showing an improvement in women across many spectrums. But if you look at the economic participation spectrum, women have moved up by 33%, up from 60% to 80%. The score has improved. Now, this is just over the last decade. Labor force participation in women has moved up from 60 to 72%. So the probability that your wife will work has moved up from 60 to 72%. Okay, that's a big thing. The probability that your wife will earn something equal to you has moved. She's now earning 56% of what you probably earned, all the way up to 97%. The probability that your wife will be a technical professional has moved up from 31% to 37%. You're looking at 19%. So I mean, has moved up from women are now represented from 31% to 37% of technical professionals. In terms of legislators, senior officials, and management, women have now moved up from 19% to 40%. So the probability that your wife will be a manager at work, have access to a higher salary, a technical professional, has also increased. Women in top management, I think this is the only one that has declined, has gone from 22% to 13%. Women in the formal sector has gone up from 10% to 18%. So formally employed women with access to higher salaries. Remember what we said. We're in the formal sector, women are actually earning more. They're earning 20% more than men per hour. So already, with the fact that we've almost doubled the percentage of women in the formal sector from 10% to 18% due to professional increase, due to managerial positions, and due to higher education outcomes, we're actually seeing that women are now have got higher earnings capacity. And also firms with owners with women has risen from 37% to 42%. In other words, female entrepreneurship is actually on the rise. So already this economic data is saying that you have more empowered women. And you can see across various status that says your divorce rates are unfortunately are a social price that are happening with more empowered women. And look, a lot of women can attain to this, that they're not tolerating a lot of the behavior that they used to. Now, here's some data that we do have from other studies. Now, unfortunately, there has not been enough study done in Zambia. Okay, when it comes to this, and I'm going to bring a recommendation of what we should be doing in order to improve people's marital decisions and to give them a little bit of eye opening before they go in. And we've all seen the ups and downs of this. Now, I will start by saying marriage is a very complicated issue. Okay, I think we all can attest to this. It's a very, very complicated issue that is not easily cut and dry. But I think any information is helpful in trying to make better decisions, especially in this field. So let's take a look at some of the studies. There are two studies I'm going to cite when it comes to marriage, life and marriage. Now, speaking to some of these numbers, and you're looking at what are the drivers of infidelity and divorce, especially in marriage, and how does the economics of the household play into infidelity and divorce. That's specifically what we're trying to look at. How do the economics, because we've seen women make a lot of economic progress. Now, what are the things that tie to this? Now, there are two US studies that we use which do tie in with the cross-national Sydney study, and they went into a little bit more information. Professor Kristen Musk, from Cornell University, studied who are the most likely to commit adultery. Okay, so this is one thing. Who are the most likely to commit adultery in a home, and what are the circumstances, specifically the economic and earning circumstances, between the disparity between men and women that leads to infidelity coming into a home? Because if you look at the divorce data, you keep seeing infidelity is a common thread that's actually coming out of this. It's economics, communication, and infidelity. These three things are really serious when it comes to the causes of divorce. Now, the first thing he said is the most likely person, shockingly, the most likely person to commit adultery is a man who is economically dependent, not independent, dependent on his wife, where his wife earns 70% of the household income. So whenever you see a household like that, what you do find, what was revealed in the study is that the male who feels slightly emasculated then unfortunately goes and plays around on the side to try and win back their masculinity. Ironically, the person who's the least likely to commit infidelity is a female breadwinner, in that the female breadwinner is often tries to do what's called bad behavior neutralizing actions. In other words, you do find that female breadwinners take an excessive stance in trying to be a homemaker in order to assuage the fears of the male who is now being kept. And as a result, there's a risk She really overextends herself, exhausted, tries to be an extra mother, tries to be all sorts of things. She's the least likely, and she's worried that if she goes and has an extramarital affair, she actually ends up even scaring him even more. So usually you find that female breadwinner is often the least likely person. The second most likely person to commit adultery is a man. The second most likely person to commit adultery is a man who earns more than 70% of the household income, as he's likely, not he does, as he's likely to see his wife as a piece of property who cannot freely decide to leave. Should he commit adultery? So should he commit infidelity? So that's the second most likely. And the third most likely person to commit adultery is a woman who earns less than 30% of the household income and is an economic independent who feels insecure and often neglected by a man who's usually overly industrial, usually not at home. So due to neglect and insecurity, you do find that a woman who earns about less than 30% of the household income is the third most likely person to commit adultery or to commit infidelity. And these are the things that actually lead. These are one of your triggers to divorce. The next part of the study also revealed that the least likely people is one, a woman who earns more than 70% and she already feels her husband is emasculated and does not want to add salt to the wounds. The next person is a man whose wife earns 75% of his income or the household income, in that he does not see her as any of a challenge, but he also does not see her as a dependent, and he knows that she can leave without her having too much of an impact. She can actually manage her own lifestyle. So some of this data actually shows us who are the most likely and the least likely, and how household economics plays into it. Now, how does this translate into divorce? Well, what we've seen is the most likely households where we do find, this is a Harvard 2016 study, the most likely households where we do find a lot of divorce, is that while women are likely to get cheated on in independent marriages, whether male or female breadwinners, however, female breadwinners are less likely to tolerate infidelity, especially due to three main factors. One, they feel hurt by the fact that they have a lower propensity to cheat. They are 3 times less likely to cheat than a dependent woman. So a breadwinning woman is 3 times less likely. Also, they feel hurt by the fact that they often tried to allay the fears of their male counterpart, and it did not work. And also, 3, they have no fear of being alone because of their economic situation. Their higher financial status leaves them with no fear. So these 3 factors already make it more likely that they're not going to tolerate, while unfortunately, a woman who is economically dependent on a man, even if he does commit infidelity, is less likely to leave because of the lifestyle downgrade that she's likely to face. So the most often situation is the fact that, one, a female breadwinner, which is becoming more prevalent in society, because women-led households in Zambia have increased from 16.2% of households in 1993 to 27, going on to 28%. So we're getting towards a point where somewhere in the middle of this decade, 1 in every 3 households in this country will be female-led. Okay, so in female-led households, we're talking about a woman having a dominant stance of the income of the home. So it does need us to actually now start having some sort of guidance. Now, although this may touch on cross-national data, it still does need us to start creating more local pools of data. And therefore, we do need probably our churches and our family research institutions to start going into a little bit more of the divorce data to reveal what are the trends that are likely to give the outcomes of this, to better prepare younger couples who are trying to go into marriage life. It is important for institutions such as the Churches Association of Zambia and the Evangelical Fellowship of Zambia to come together to start making sure that they research all these 30,000 divorce cases and start to see the underlying economic factors. Because one of the things I want us to actually take a look at is this simple statistic that came out of Harvard that actually said that the least likely marriage to face any infidelity and the least likely marriage to therefore face a divorce is where the man or the woman, neither one of them out earns the other by 50%. Okay, so if the lower person earns 10,000 kwacha, the upper person earns 15,000 kwacha, these are your least likely people to face divorce. I'm not saying they can't. I mean to face infidelity and therefore have infidelity-based divorce. These are your least likely people. So if you have these circumstances, perhaps then people can start to look at it. So the question is, does income play a role in a marriage? It does seem to appear that it does have quite a significant effect. Income disparities between the man and the woman seem to have quite a significant effect on infidelity. And with the relaxation of divorce laws and the more social acceptance of divorce, it appears that that infidelity is now playing out into divorce. So these are just two things that we want to look at. If we're going to try and affect it, then we need to start making sure that we have a lot more information up at hand. Now, I would be starting a conversation regarding the I would starting a conversation dividing diversification of income. Unfortunately, we have run out of a bit of our time right now, but we are going to get a few questions that we I will try and attend to. We are seeing that Blackchain Joe has said, Munyumba yesterday, Nyumba, you didn't post yesterday the personal productivity equation. If it's possible, could you post that data and the five things you need to know today? Money FM WhatsApp group. I also need that data to recommend single lump sum investment targets for wealth by age 60. Check the page. I'll have those up for everyone by tomorrow when I do my Tuesday data. You'll be able to see that for everyone. And we'll make sure of that. Thank you very much, Blockchain. We did see Lubindan Dambo also say that also the status of men has declined. Men have not taken up their God-given responsibilities. It's true that male economic productivity has also declined. It's stagnated / declined, which has contributed to a lot of this. The point is that the disparities between the two have widened. One, because women have progressed. Two, because men have stagnated. And this has therefore led to a more difficult household dynamic, or at least a new household dynamic, which a lot of people may or may not have been comfortable with, and maybe they don't seem to understand it. So I think what we need to do is navigate the rise of this. But what I think we need a lot more of is we need a data-driven approach from those entities to be able to come down and say, what are the analytics that are happening behind all of this? Because the family is the cornerstone of society. A nation is nothing but a collection of families who decide to hold a constitution together and decide to share resources and to manage shared resources together. If the families break down, the nation breaks down. So we need to make sure that we have a strong set of families. Remember that 94% of millionaires come from family structure. Remember that a lot of entrepreneurs, if not 70% of entrepreneurship, come from family structure. Remember that better education outcomes, people who are actually able to complete school, come from family structure. So if we want enterprise educated people and strong finance, we need strong families. And how do we do that? We need to start looking at what are the dynamics, because we can teach people the spiritual laws of family. We can teach people the traditional laws of family or traditional principles. But if there's no data to help them make the decisions that they're making, they're going at this in the most blind way. It is already a highly complicated situation. It does not get any better if we do not give them enough information as to what is driving the dissolution of marriage so that they can strategize around how to dissolve it. I, as a financial advisor, are packed full of data. So therefore, I'm able to actually help people make decisions on their money and help them avoid the pitfalls and mistakes that many have made before them. So can we start collecting and gathering the data at a time when it's rising before it gets entrenched in society? We still have the majority of our families still together. And while we still do that, let's not take it for granted that it can stay like that, because you've got countries like America where you've seen family structures basically melt in front of everyone's eyes, where the rise of the single parent household has become so strong, and most children are now being raised by single parents. It can easily get there. We still have 2/3 of our children being raised by two parents. We still have majority of our married couples together. And while that still stands, can we please try and address this issue by taking an approach of trying to understand what are the factors behind it, and not just pumping out sensational headlines for the purpose of us to have salacious conversations. Let's actually strategize as to how we can get the next generations to go into marriage with their eyes open. And this is actually quite a big one of the final things I wanted to put into it is also because people are now getting married later in life, they're getting married into their 20s. They're getting married into their 30s. Now, the good thing is we've gotten rid of child marriage. They're getting married into their 30s now. So when people are getting married into their 30s, they've got assets on the line, they've got higher incomes, and they've got an established career. So there's much more risk that they're trying to navigate with the marriage decisions that they're making. So that is something that we just have to really pay very close attention to. And finally, as I said, our final conversation had to do with diversification of income. I think we have a little bit of time left. We have a few minutes, about 7 minutes left, and we'll try and go through this topic of diversification of income. So we've gotten to this thing where we've talked about things like multiple streams of income. And multiple streams of income has been a big conversation for people. And I gave out a very simple point where I said multiple streams of income does not mean multiple industry participation. It means multiple streams of income using the single mastered skill that you have. Here's a clip by Jordan Peterson where he actually talks about his many streams of income. And listen to the fact that, remember this, Professor Jordan Peterson is a doctor in clinical psychology. But listen to the streams of income that he has and listen to how closely they're tied to his actual mastered profession.
Aimed of making money. It's very hard to make money.
Can I ask you bluntly how much you make?
I make $80,000 a month on Patreon. My book is selling about 20,000 copies a week. I have royalties that probably amount to something approximating $1.50 on each of those. The tours garner about $35,000 to $50,000 an evening. I have a business that's generating something in the neighborhood of $200,000 a month for me personally. There's some other smaller sources of income than that.
A lot of money.
Yes.
Out of this.
I certainly am.
So you're listening to a man who's basically making about $300,000 a month. And he's telling you that he's doing it because he's running a business where he does psychology training online. He's written books about human psychology, which are selling 20,000 copies a week. And he's making $1,500 a month, a week, $1.50 per book. So in other words, he's making about $30,000. So if you add that onto it, that's $120,000. He does speaking arrangements where he talks about psychology. He goes on speaking tours where people go to his seminars on human psychology. Okay, and on Patreon, people subscribe to him on a premium level about human psychology. So if you want to understand, he's using a single skill by putting it on Patreon. He's putting it in books. He's putting it in speaking. He's created an application and a training course. He's diversifying the utilization of a single mastered skill where he is world renowned. Okay, because there's this constant conversation about trying to be a jack of all trade and not being a specialist. And people have this conversation a lot. And I keep telling you that those of us who sit in the space of actually managing people who have wealth, those of us who actually have to deal with customers who come and give them their portfolio of information, you often find that the people who have built large amounts of wealth are highly concentrated in their time. Okay, they've managed to now parlay that into a lot of flats and things like that. But the main thing they do one thing that brings in, they make their money in one way, but they figured out how to do it in multiple streams with one way. Okay, they take one way and they do it very well. Okay, now, unfortunately, because I'm a local, Black, young financial advisor, a lot of people feel this need to argue. So let me give you these words from white American lady who's got 25 years of experience, who has been in this industry and runs a $3.1 trillion portfolio from JP Morgan, one of the biggest wealth management portfolio, Mary Callahan Erdos. And listen to what she has to say about how people make their money.
Master that one thing really well. I've seen it, the way that I've seen it over the 25 years that I've been doing this is, most people make great sums of money by doing one thing really well. And when they master that one thing really well, like maybe running the largest and most successful private equity firm in the world, nobody can beat them at that. And that's the way they make their money. Then to keep their money and continue to grow it, the trick is diversification. Diversification comes with having to master lots of different things. And generally, people find it hard to master lots of different asset classes, sectors, countries, areas to invest, because they don't have the time to do that. And so being able to get other people to help with those components, maybe it's just the ones you don't master, maybe it's all of them, maybe it's components of that, is the way most successful people have done.
Okay, so I think what you can hear from that very simple piece of advice is most people make their money doing one thing very well. Even Jordan Peterson says it. People who are very successful focus in one specific area, become very well known for it, and then diversify the ways they make money through it. So various people make money by the people who are very successful, manage to build wealth very well, concentrate their focus into an area and become a name in that area. And once they become a name, they become sought after, they gain premium price. Let me give you a simple example here in Zambia. Here on Money FM, Mr. Fumbeshi. Mr. Fumbeshi is well known in the spectrum of property. He's good in property surveying. He has written a book. He has done courses. He has done a masterclass. He has diversified and splintered himself into the various aspects of property. And thus he's a name in that field. And that's what you need to understand. When you concentrate in an area, you can often have a lot more opportunities open to you, because where people need your skill set for specific purposes that have to do with your area, they seek you out, they pay a higher price. And because they pay a higher price, your 1 hour makes more than anyone else's hour who's trying to diffuse themselves into many things. And there's a simple aspect which is talked about, like light. If you concentrate light through a magnifying glass, it can burn through stuff. But if you diffuse light, it can touch skin. It won't even do anything. So diffused light is weak. Concentrated light is strong. So concentration and focus is what a lot of people have to start looking at. Now, when we're talking about diversification of income, you need to do that in your concentrated area of focus, especially at the beginning of your career before you've amassed a lot of money for diversification, because diversification is going to cost you money. If you don't have wealth, then you cannot easily diversify, because trying to diversify without a bundle of money made is going to be a huge risk, because you're splintering your time. So what you need to think about is one simple concept. Focus your time, diversify your money. Okay? Very simple. Focus your time. Okay? The things that consume your time, focus. The things that require your monetary investment, that is where you start to slowly diversify into areas. And you're going to need professional help when you need to diversify, because those are not your areas of expertise. Find people who are also focused in those areas so that you can get them to help you make those better decisions. That is what making a lot of money in one area can do for you. You can splinter it well into other areas. With that, I would like to try and wind up today. We'll see you all tomorrow as we go through Treasury Tuesday and we go through wealth creation. We're still going through our levels of wealth sectors, and then we'll be able to go into some of the data coming out of tomorrow. But with all that, hope you've had a wonderful day. God bless to everyone. Thank you so much for joining us.